So, time for a bit of an update on financial markets. There actually is a bit of a crossover episode since it also has to do with the Wu flu. Since there has, the markets have been spooked this week over the Wu flu. There's been quite a few down days. In fact, I believe that a lot of the indexes are down for the year now. But to be honest, I haven't been following the day-to-day of the markets because normally, just as a base case, when there are scares like this, um, and this is essentially a scare over an endogenous shock. I don't mean to sound like one of the ridiculous bulls that say that everything is a buying opportunity, but these sorts of cases tend to be buying opportunities when it comes to stocks. And that's because, in my opinion, in the theory of the business cycle that I subscribe to, your business cycles are not caused by endogenous shocks. Most of the time, the market will recover fairly quickly from endogenous shocks. That's not really, and of course, endogenous just means some outside event that couldn't be foreseen. A black swan, that sort of thing. These natural disasters or an outbreak like this, most of the time it's really not going to be as bad as we think. And so that initial sell-off is normally accompanied by a relief rally. And so all else equal, I would say to the folks who are really worried over this coronavirus thing spreading into financial markets, to settle down and this isn't going to be the trigger that leads to financial apocalypse. However, we are not living in a vacuum, and all else is not equal. If you catch my meaning, there are other things going on here under the surface other than the coronavirus, which are things to be legitimately concerned about, which can lead to the end of the business cycle. And what I think is the biggest risk to our entire economy is over leveraging. We have a very heavily levered economy that is sustained pretty much entirely by debt, by the idea that debt is going to continually get cheaper, and that has been pushing things along since the Reagan administration. So long as debt continues to become cheaper and cheaper, so long as interest rates continue their downward trajectory, we are able to continually inflate our economy higher and higher. We're able to inflate asset prices. In doing so, however, we create an asset bubble or a credit bubble or a bubble in everything. And so once a bubble like this exists, you want to look, first of all, at the strength of the central bank to see, okay, well, how much power, how much of their energy are they really expending on trying to keep this bubble sustained? In other words, how much ammunition does the central bank have left? And two, you want to watch out for potential needles that could prick this bubble. And of course, the weaker the central bank's position is, the duller the needle it will take to pop the bubble. That isn't to say that a central bank with sufficient ammunition wouldn't still lose against a sufficiently sharp needle. But at this point, I'm getting a little too vague with my analogies, so I'll move on to the concern with the Fed. If you look at the Fed, how much ammunition does the Fed have to throw at this market to try and continually inflate it higher? Well, interest rates right now, the Fed funds rate is at 1.75%. Okay, so just barely above zero. Quite, historic lows by, any standard that goes back more than 10 years. So they have very little room to cut to try and save this market. You could say, well, they could go negative, but negative interest rates empirically have not had any real great effect where they've been tried in Europe and Japan. They have not proven to be nearly as potent as cutting interest rates when the interest rate is positive. But, of course, the Fed does have other tools like they unveiled in 2008, and that, of course, was quantitative easing, which really saved the day back then, when the Fed was just able to directly pump money into financial markets and use the portfolio channel, as Brian Bernanke called it, to try and increase the money supply in a specific direction to pump up asset prices. And so you would think that, well, the Fed has how are they doing on that front? Well, at this point, they've already launched QE, essentially, through what they call permanent open market operations, or POMO, also known as not QE. but it's basically QE because they're not the whole idea between why this is not QE is, well, they're not buying they're not buying things across the yield curve, which again it's a little complicated. I won't get into explaining that. But nevertheless, the Fed is injecting massive amounts of liquidity in the market all the time, as it is, before any of this coronavirus endogenous shock thing came down the pike. And so to see the markets react so negatively on when the Fed already has rates so historically low, they've already cut 3 times. And they've, once again launched QE. I guess, the only round they really have left in the chamber is officially announcing QE4, or some would call it QE5 if you count not QE as one of the phases of quantitative easing. So overall, the Fed doesn't really have much ammunition. So if you look at this coronavirus outbreak not as the cause, as the reason for the market going down, but rather as an excuse, as the needle which pops the bubble, which exposes the underlying weakness of the current prices in the market, well, then this whole coronavirus thing starts to look a lot more scary. Because let's say the coronavirus itself is not responsible for handicapping the global economy, and that the effects of it are not as widespread as people initially feared. Once this virus, once the scare from this virus in the financial markets sets off, the correction, people might start to worry about other things that are going on, the other underlying weaknesses in the market, and so therefore they'll, even if they lose their original reason for selling, they'll continue to sell because they've found new reasons. So they no longer will need the excuse of the coronavirus at that point. It's very similar to how in France the Yellow Vests originally came out to protest an increase in fuel taxes. Well, Macron took that off the table, and they kept protesting. Why? Because there were underlying problems in France beyond just that fuel tax that people were upset about. So even when they took that off the table, people kept protesting Macron and were calling for him to resign from office. So we have a very fragile stability when it comes to, in society, whether you're talking the economy or, politics. And so our overlords, whether they be political, such as Macron, or financial, like Jerome Powell, really need to watch things closely and make sure that people don't ever get scared over anything. You have to keep the herd calm. So if this sell-off continues into next week, and the Fed and the CDC are not able to calm the market sufficiently, well, then this sell-off will become about something much broader than just the coronavirus. Because you see, prior to this rally, or prior to this sell-off, most of the major indexes were, from a technical perspective, way overbought, but that's not something I really pay attention to. Fundamentally, however, in addition to that, stocks were way overvalued. The U.S. has had not much economic growth over the last couple of years, or the last year or so, if you want to just take from the 2018 lows, Christmas Eve 2018, that was when stocks bottomed after the last correction, or near bear market. It was almost 20% down on the S&P, I think. Since then, earnings have not been growing much, and the overall economy has not been growing much. GDP is not up much. However, stocks are up something like 30%. So in other words, there's a lot of hot air under this market that is essentially being pumped in by Fed liquidity and by, just optimism. So if you do away with that optimism and the Fed tries to restore it by adding more liquidity, well, the question is, how much liquidity can the Fed really add? And the way things are looking, it doesn't seem like much because the Fed is already, working overtime to try and keep things afloat as they are. If you had another 2008 style scenario to where people actually did start to sell off significantly, the Fed does not have hardly anywhere, any room to cut, and they're already doing QE. So, at the time in 2018, when the markets fell, the Fed was still doing quantitative tightening. They not only were not doing QE, they were doing the opposite of QE. And they were still raising rates. So now you have a situation where the Fed has been cutting rates and adding liquidity through more QE. What are they going to do when things, if we have even a repeat of let's not say 2008, let's say a repeat of 2018. Well, the way things are looking, it doesn't look like the Fed is going to be able to stop at that time. It looks like that they were only able to delay the inevitable for a little while. And of course, it's easy to say, well, sure, that'll be bad for the stock market, but the stock market's not the economy. As I've explained many times, I don't think that that's true right now. I think that the stock market, in many ways, is the economy because it's driving consumer sentiment. People are spending, the average consumer is spending way more money than they really can afford to. People are racking up credit card debt. They're borrowing money to buy way overpriced homes, which, again, I can't really blame them because homes are overpriced right now. What are you going to do, not have a house? I don't want to rent right now either because rent is absurdly high too. But the fact of the matter is that people would not be making these decisions and taking out so much debt if interest rates, one, weren't so low, and two, if they didn't have such so much confidence in the economy, and three, for those who do own stocks, if they didn't have that extra income from the rising stock market. So what happens is, if stocks fall, is the people who don't own stocks see stocks falling as a bad sign for the economy, and they will slow their consumption, rightfully. And the people who do own stocks will have less, will be making less money, and they'll have to tighten their belt too. And so you will see an economic contraction as a result of falling stock prices. That is assuming that the decline cannot be contained. You see a stock market collapse or correction or such is kind of like one of these outbreaks. Sometimes they're not that big of a deal, but if you cannot contain them, they can become a very big deal. And so just keep in mind that there's all this trouble under the surface. There's all this leverage. There's all this, underbrush, essentially. If you want to understand, it's kind of like a wildfire. When you have these forests that don't burn for decades and decades, you get all of this dead, underbrush, essentially, that, makes for good kindling if anyone ever lights a match. And, this coronavirus, even if in and of itself it doesn't burn the forest down, it can be the spark which starts the fire. And so with that said, if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. If you haven't already, please do subscribe because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.